Hey, if you're not having fun, it's on you. I'm having a good time. Let's roll through these and learn a bunch. Now, let's talk about the sources of these evidence pieces. Now, let's just kind of jump down here. This is a hierarchy from the most reliable audit evidence to the least reliable. The first and most reliable piece of audit evidence is anything that comes from the auditor's direct personal knowledge. Meaning, if you are watching the client or someone who works for the client count the inventory, that is something from your direct personal knowledge, and that is going to be the most reliable audit evidence because you were there for it, you know it, you witnessed it. Next is external evidence. Now, external evidence, like a bank statement or something from the debt servicing company, something from a customer, from a third party, so not the client. Internal evidence is something from the client, which in many cases you will have to use items and pieces of evidence from the client. It's just with the caveat that it is less reliable. These are going to be reconciliations, statements prepared by the client, by their accountants, by their internal audit function. And lastly, oral evidence, any statements made by anyone, because even if it's written down, it still has to be transcribed into words. But at one point, it was oral evidence, and it was not something that was written down from the beginning. So yeah, just memorize this, be familiar. I'd say, yeah, there might be a question which asks which is the most reliable, but also more importantly, this is for you to understand if, let's say, a question asks you, okay, you've got a bank statement and you've got a report prepared by the client, which is more reliable? Well, I'm going to go with the bank statement. Now let's dive into kind of what we have up here. Evidence obtained from an independent source provides the highest level of assurance. And guess what? You, as the auditor, are supposed to be independent, and hopefully you are. So that is going to be the highest level of assurance. And then independent also would be external sources. This includes independent third parties and the independent auditor. Examples include securities valuations from a Bloomberg terminal. That's pretty independent, right? If you're just Googling and looking up on your Bloomberg terminal how much a stock is worth, then that's pretty independent. And for those of you who are not familiar with what that is, basically a very expensive computer with a subscription to Bloomberg, the company, where you can look up stock valuations, debt information on bonds, anything like that. And also the auditor's observation of the inventory count, that's going to be the highest level of assurance. Evidence obtained by the client, such as accounting records, need to be corroborated by the auditor using evidence. So yes, you can get evidence from the client, which is internal evidence, but then you need to take additional procedures and obtain additional documentation in order to verify what the client says. Generally, the more effective the client's internal controls are, the more assurance the auditor has over the accounting records and financial statements. And this is where we kind of get into professional judgment, right? However, this data can never be sufficient and appropriate evidence alone. You need some more. Talk about opening balances, and let's talk about this conceptually first. You are auditing the financial statements. Those are year-end balances for the balance sheet, and you're auditing the transactional value, the period of the income statement. Then obviously you got other financial statements and all that, the cash flows. But thinking about just the balance sheet for now, let's say the ending balance for cash is $10 million, but we also obviously have a beginning balance. And this client presumably was audited last year. So the beginning balance of cash, let's say, is $9 million. So they gained $1 million in the year in cash, net increase. We can trust this, presuming it was audited by a reputable firm or audited by us, right? This is the opening balance. This is the January 1st balance of cash. And this is the unaudited, but soon to be audited, year-end balance of cash for 12/31, right? For the end of the year. We can use this. We can use this because, it's kind of like we don't have to start from scratch from the year they opened business, right? We can just say, okay, it's for the 1 year. We trust the beginning balance. Let's work our way and do a nice little calculation. If any of you have done BEC or FAR, you may be familiar with the base formula where you've got BASE, beginning balance, addition, subtraction, ending. Just kind of touching on this topic here, bringing it full circle for your understanding, right? Where let's say we have an ending balance of $10 million in cash, and then we have a beginning balance of $9 million, as we mentioned. Now, what's one way to verify that independently and kind of instead of just trying to look in the bank and see that they have 10 million, you could also additionally calculate all the additions, so all the deposits, calculate all of the withdrawals, and see if your math adds up. So that's recalculation. You probably wouldn't do that for cash, but you could do that for debt. Why would you do that for cash? Because you can just pretty independently and accurately look in the statement, the bank, and see what's going on there. Now, the auditors should obtain sufficient appropriate audit evidence about whether the opening balances contain misstatements that materially affect the current period's financial statements by what? Now, like I said, hopefully we audited the financial statements last year and we can trust the opening balances. However, if you're not sure and these were not audited, these are the procedures you would do. Maybe it's a first year audit or someone else audited, and maybe you can't trust them last year. You would determine whether the prior period's closing balances have been correctly brought forward to the current period, or when appropriate, have been restated. That's a simple check, right? So let's say this is 1/1, right? This is the January 1st balance, and this is 1/1 year 2. This is 12/31 year 2. So this is the year under audit, right? Year 2. However, let's say we look and the 12/31 year 1 financial statements, 12/31 year 1, let's say, unfortunately, for some reason, which we obviously would have to get to the bottom of, it says $8 million. So presumably they didn't just gain $1 million in cash overnight. There was probably an issue, right? Generally, your balances are going to be the same day to day. Now, obviously, it could change, right? But these balances should pretty much be the same from the year end to literally the next day. Also, hey, it's New Year's. What are you doing? Working, changing your cash balance. So that is something that we would investigate. We want to make sure that these are the same, and if they're not the same, we can corroborate the reasons why. So this is an important cutoff, making sure those are understood. We can also determine whether the opening balances reflect the application of appropriate accounting policies, which cutoff, I'd really just focus in on that. And lastly here, we can obtain evidence about the opening balances by evaluating whether audit procedures performed in the current period provide evidence relevant to the opening balances and performing one or both of the following. We can do these, and what are these actions? So when the prior year financial statements were audited, we can review the predecessor auditor's audit documentation to obtain evidence regarding the opening balances, or we can perform specific audit procedures to obtain evidence regarding the opening balances. Again, in reality, if you audited the statements last year, you're probably good to go, right? If we did all of the work and we did a proper audit with enough work last year, we're fine. However, this is per the AICPA. This is per what you would have to do if you can't trust the statements, if you can't trust the work that was done last year. Accounting records and entries. So accounting records generally include the records of initial entries and supporting records, such as checks and records of electronic fund transfers, invoices, contracts. So all of these items are going to be within the client's accounting system. And these are what we mean when we say the accounting records. So checks, obviously, people are paying you in cash and you're paying out in cash in the form of a check. Electronic funds, you get that Venmo, get that Zelle. Invoices, contracts, important documentation to verify purchases, sales. The general and subsidiary ledgers, meaning this is where all the transactions are listed out. Journal entries made, which then go to the ledgers. And other adjustments to the financial statements that are not reflected in formal journal entries, and records such as worksheets and spreadsheets supporting all these other items, right? So talking about what are these accounting records, the journal entries, understanding what you're going to need to sift through as the auditor. These are all points that you're going to have to look through and examine and assess. You're going to perform analytical procedures on these. You're going to perform substantive procedures. You're going to gain evidence on these records. You want to make sure that there's no fraud and that they were just done properly, because fraud and error, right? That's what we're concerned about as an auditor. We're concerned that the financial statements are not materially misstated for both of those reasons, fraud and error. Problem, if it's done either way. If it's fraud, it's obviously more of a problem, but whether it's $10,000 in misstatement because of fraud or error, it's still a problem. The entries in the accounting records are often initiated, authorized, recorded, processed, and reported in electronic form. Makes sense. We're not really doing that by hand on paper anymore. In addition, the accounting records may be part of an integrated system that share data and support all aspects of the entity's financial reporting, operation, and compliance objectives. Understanding the client system, if you've worked in auditing, and this is probably nothing new to you, right? Just understanding what you're looking at when you're going into the client system, whether it's an in-house system or it could just be QuickBooks. And if you're not familiar with QuickBooks, think of just some sort of system where we can go in and make all the entries, generate reports. We're storing all these invoices, contracts, all this data, your overall integrated accounting system. Kind of think of it like an accounting information system, thinking back to BEC as well. Make sure you're stretching, make sure you're drinking your coffee if you need to, make sure, most importantly, you're having a good time. Power through it and keep going. Management. Let's talk about management. Management is responsible for the preparation of the financial statements. We know that, we drilled that to death, and we will continue to do that based on the accounting records of the entity. Management prepares the financial statements, and just like as an auditor, we need evidence for our audit report and our opinion. So too does management need evidence for their financial statements. They can't just generate financial, regardless of an audit, right? They still need evidence. If they're not getting audited, they still need to make sure that they're doing a good job, that the financial statements actually have a basis for why the numbers are the way they are. The auditor should obtain audit evidence by testing the accounting records, for example, through analysis and review, reperforming procedures followed in the financial reporting process, and reconciling related types and applications of the same information. Recalculating debt balances, right? Just a simple saying, okay, the client has $10 million outstanding at a 2% interest rate, and let's say it was only for 6 months of the year, right? Doing a calculation to make sure interest expense is correct. That's something the auditor could do. Just calling up the customers and saying, hey, do you actually owe this entity $10, right? $100, whatever that might be? You look into that. That would be your process and procedures. You want to get those accounts receivable confirmation forms out. Through the performance of such audit procedures, the auditor may determine that the accounting records are internally consistent and agree to the financial statements. You can do that, right? So you're looking through and everything matches. Now, those can be forged, right? Even if everything agrees. Now, that would be pretty bad if you committed fraud and your evidence as the management, right? If management doesn't have reports that at least try to hide their fraud, well, they just did not do a very good job there. However, because accounting records alone do not provide sufficient appropriate audit evidence, right? Because management can go in and edit the numbers on the underlying records, which then go to the financial statements. So those do not provide sufficient appropriate audit evidence on which to base an audit opinion. The auditor should obtain other evidence. Drilling that down, making sure you're familiar. Think about it. If management intends on fudging the numbers of the financial statements and they're smart enough, they would alter the internal data and accounting records to match the financial statements. And maybe I'm teaching you how to commit fraud, but I'm going to be honest. If this was not going through your mind and you were intending on committing fraud, I'm not worried that you're not going to get caught. So, moving on to our next one. Information to be used as audit evidence. Other information that the auditor may use as evidence includes minutes of meetings. This is minutes of meetings of the board of directors, of management, right? Anything they're discussing. Confirmations from third parties. Industry analysts' reports. This could be used for going concern or possible obsolete inventory, right? If you've got a lot of inventory and there are reports that the product they make is becoming obsolete, that could be audit evidence for writing down the inventory. Comparable data about competitors, which could also be used to help with the income statement, profitability, making sure those numbers are properly stated. Controls manuals, information obtained by the auditor from such procedures as inquiry, observation, and inspection. If you are inspecting, observing, or inquiring, any of those things you do, document it. That is now going to be audit evidence. And other information developed by or available to the auditor that permits the auditor to reach conclusions through valid reasoning. Pretty much saying anything and everything that helps you. Now, there are standard pieces of evidence, as we've been seeing and we will continue to see. However, think outside the box sometimes. If you need something else to be audit evidence and it's legitimate and it's verifiable, then go for it. It helps you to obtain your opinion.
Hey there! Are you ready to not only pass your CPA exams, but truly understand and enjoy the material while studying? I know it seems impossible, right? Especially to enjoy the material? We'll do it together. Tap into the power of CPA.examprep.ai, where we've got personalized quizzes, multiple choice questions, memorization guides, flashcards, simulations, all tailored to your learning. Our adaptive study planning puts you on the fastest path to success and lifts you back up if you fall behind. Avoid wasting your precious time and money attempting an exam with a low chance of passing, because who wants that? We want to get you through this process as quick as possible. Our exam readiness prediction lets you walk in with confidence, knowing that you're prepared for success on exam day. Thankfully, there's no payment method needed to get started, so why don't you come join us? Visit cpa.examprep.ai and let's achieve your exam success together.